For 4 straight months, the main US stock index has marched to fresh record highs. Then one post on social media wiped out roughly $7 trillion of market value in a single session after a threat of a 100% tariff on Chinese imports. Within 24 hours, the same account said, "Everything is fine," and prices bounced as if nothing happened. Look at what that kind of whiplash really signals. It is not just about one politician or one tweet. It is about a global financial system so stretched that a single headline can swing trillions, while the deeper signal comes from somewhere else entirely: gold and other outside assets that do not depend on corporate earnings or central bank promises. Watch the divergence that opened up this year. In local currency terms, the major US BC equity index keeps printing all-time highs, but measured in gold, that same index has been grinding down toward its weakest levels in more than a decade, while the metal itself has surged to records above $4,000 an ounce. In other words, stocks are winning the points on the scoreboard, but losing the fight on real purchasing power. Check the historical rhyme. When equities fall or stagnate in gold terms, it has often lined up with regime shifts rather than simple corrections. The inflationary 1970s, the dot-com unwind around 2000, the run-up to the 2008 crisis. In each case, the surface looked like a normal market cycle. Underneath, the measuring stick, money itself, was changing. The pattern is simple. Follow the money, find the pressure. Pause here for the first checkpoint. If stocks are up in dollars, but down in gold, the question is no longer, is there a bubble? The question becomes, what is the system quietly repricing? That open question sits behind the rest of this story. Notice how the latest tariff shock fits into that picture. On October 10th, Washington threatened a 100% levy on essentially all Chinese goods. The effective rate on many products would have jumped into the 140% zone, a level that does not just slow trade, it kills it. Markets reacted instantly. A drop of almost 3% in the main US index, one of the sharpest single-day losses of the year, and a scramble into gold, the dollar, and short-term government bills. Watch the snapback. Within days, a temporary truce and softer language calmed equity traders. By early November, a meeting between US and Chinese leaders produced a deal that postponed the worst-case tariffs for about a year. Headlines called it a relief rally. But structurally, the tone had changed. A complete shutdown of trade between the world's 2 largest economies had moved from unthinkable to not impossible. That shift does not disappear when the index recovers. Check what happened on the other side of the Pacific. Chinese exports to the United States have already taken a heavy hit this year. In May, shipments to America fell by roughly 35% compared with the previous year, even as total exports worldwide still managed modest growth. At the same time, the share of Chinese exports going to the US has dropped from around 18% before the first trade war to single digits today. Notice the flip in that math. Beijing has been quietly rebuilding its export machine around Southeast Asia, Europe, and parts of Africa. The message is blunt. The trade relationship with America remains large, but it is no longer the only lifeline. When 2 partners in a long marriage start building separate bank accounts, it does not break the relationship overnight. It does, however, tell where the story is moving. Again, follow the money, find the pressure. Here's where the macro backdrop makes this more than a trade squabble. The US federal government just ran a deficit of about $8 trillion over the last fiscal year, close to 6% of national output. That gap is financed in bond markets that already hold debt near 100% of GDP. The Treasury is rolling and issuing hundreds of billions every quarter, with the next major refunding announcement already scheduled for early February 2026. Look at what that means in plain language. Each time older, cheaper debt matures, it is replaced by new bonds at today's higher interest rates. It is like refinancing a giant adjustable rate mortgage for an entire country. The more often it happens, the more interest costs crowd everything else. As long as investors keep buying, the machine runs. If they ever demand a higher premium all at once, the adjustment hits the entire system, not one sector. Check the central bank side of the story. After one of the most aggressive hiking cycles in modern history, the Federal Reserve has already cut its policy rate twice and now sits in a target range of roughly 3.75% to 4%. The next major meeting lands on December 9th and 10th. Markets are betting on the possibility of another small cut, even as consumer inflation has hovered around 3% and key data releases have been delayed by a long government shutdown. Notice the bind that creates. Policymakers face slowing global trade, high public debt, and sticky prices, all while flying partially blind on official data. Cut too fast, and they risk reigniting inflation or weakening the currency. Cut too slow, and they risk tightening financial conditions into a slowing economy. The yield curve has finally uninverted, but that does not erase the damage from the record-long inversion that came before. Here's the twist most headline charts miss. The forces propping up asset prices are broad, not narrow. Fiscal deficits inject demand. Lower policy rates ease borrowing costs. Corporate profit margins, especially in dominant technology and platform firms, sit near record levels. Together, those factors support not only stocks, but almost every liquid asset: gold, Bitcoin, high-yield credit, and even parts of the private lending world. Follow the money, find the pressure. Gold has climbed more than 50% this year to fresh highs above $4,000 per ounce. Bitcoin has swung from peaks near $120,000 to sudden drops below $90,000, yet still trades far above prior cycles. Central banks have been steady buyers of bullion. Large institutions have poured capital into alternative yield through private credit and non-bank structures. When the safe assets and the speculative assets rise together, the move is no longer about one narrative. Out of way, it is about trust in the unit everything is priced in. Checkpoint 2. Picture this like a building. Fresh paint on the front, record indices, strong headline earnings, does not mean the steel inside the walls is untouched. Gold, Bitcoin, and the rush into non-bank credit are like engineers quietly placing strain gauges on the beams. They do not yell, they just measure. Look at the historical parallels when those gauges start blinking. In the 1970s, US stocks mostly went sideways in nominal terms, but collapsed relative to gold as inflation and repeated oil shocks forced a reset of what money and bonds were worth. Around the dot-com bust, the broad market looked expensive and exciting, right up until corporate profits and tech valuations broke. In the years leading into 2008, credit instruments looked safe on the surface, while leverage and complexity piled up off balance sheet. Watch how today's pattern rhymes more with those regimes than with a normal mid-cycle slowdown. Global watchdogs are saying it out loud. The International Monetary Fund now flags significantly increased financial stability risks driven by trade uncertainty, high leverage, and stretched valuations. The Bank for International Settlements warns that record equity prices look increasingly disconnected from the rising stress in sovereign bond markets. The Financial Stability Board is pushing for hard limits on leverage at non-bank institutions after a series of near misses in recent years. Check the role of non-banks in this story. Roughly half of all global financial assets now sit in entities that are not traditional banks: private credit funds, hedge funds, insurers, money market vehicles, real estate structures, and more. Banks still provide a large share of the leverage to these players. That means shocks can bounce between the shadow system and the regulated system faster than in the last cycle. A blow-up in a leveraged fund can force selling in government bonds, which then hits bank balance sheets, which then feeds back into credit spreads and funding costs for everyone else. Result? The phrase, "the global financial system is breaking," does not mean one dramatic explosion. It means the old way of wiring money, trade, and risk together is reaching its limits on several fronts at once. The break shows up as a series of constraints closing in: on trade, on public balance sheets, on cross-border capital flows, and on the ability of central banks to smooth over every shock with a simple rates move. Watch the simple promise for the rest of this video. Stay to the end for 3 warning signs that separate a harmless pullback from a genuine system break, the kind that takes years, not weeks, to repair. Those signals all tie back to one idea: whether the world still believes in the plumbing underneath the prices on the screen. Notice the first warning sign: the policy wall. This is where fiscal and monetary policy hit their practical limits. On the fiscal side, sustained deficits near 6% of GDP mean governments depend on bond markets staying calm while debt keeps climbing. On the monetary side, rates are no longer at zero. Central banks have some room to cut, but not the kind of deep emergency moves seen in 2008 or 2020, without risking another inflation flare-up. Check how the calendar turns this into a countdown. The upcoming policy meeting on December 9th and 10th will show how far the Federal Reserve is willing to go in easing, while inflation sits above target and key data arrive late. A week later, on December 18th, the delayed inflation release will give the first clean look at price trends after the shutdown. Then, on February 4th, the next big Treasury refunding announcement will reveal how much new debt needs to be absorbed at current yields. If markets start demanding higher compensation around those dates, the policy wall will come into clear view. Checkpoint 3. Think of this as a bridge under heavier and heavier traffic. Trucks keep crossing. Engineers know some reinforcements are possible. But there is a point where adding more vehicles requires rebuilding the structure, not just patching the roadbed. Policy is nearing that point. Look at the second warning sign. The trade break. The threat of triple-digit tariffs on Chinese goods was not just a negotiating tactic. It tested how far global supply chains could bend before they snap. Even without full implementation, the partial tariffs already in place have diverted trade, raised costs, and accelerated the move toward regional blocs. A genuine follow-through on 100% tariffs, even for a few quarters, would amount to a deliberate fracture in the global trading system. Watch what that would mean for the real economy. Prices on imported goods would jump. Corporate margins that rely on global sourcing would be squeezed. Retaliation would hit US exporters, especially in agriculture and advanced manufacturing, at a time when domestic demand is already slowing. The result looks less like a simple recession and more like a drawn-out realignment of who trades what with whom. History shows that when trade walls go up, they often stay up longer than expected. Check the third warning sign. The funding accident. This is the least visible and the fastest moving. It happens when some part of the system suddenly cannot roll its short-term borrowing at reasonable rates. It might start in a corner of private credit, in a hedge fund strategy built on repo financing, or in a currency basis market that stops functioning smoothly. Regulators have already had to step in several times over the last decade to stabilize such pockets of stress. Notice the pattern. The accidents keep getting closer to the core. First, it was collateralized debt and structured products. Then, pension funds using complex derivatives to hedge long-dated promises. Now, attention is on non-bank lenders, crypto-linked vehicles, and cross-border dollar funding. Each episode has required bigger backstops or new rules. Each one narrows the room for the next rescue. Checkpoint 4. Imagine trying to rewire an airplane while it is in the air. That is what policymakers are attempting, making the system safer and less concentrated, while also depending on that same system to finance huge public deficits and fragile growth. Follow the money one last time, and the pressure points line up. Capital is flowing into gold and other real assets, because many investors do not fully trust long-term currency value. Money is flowing into non-bank credit because yield in traditional bonds still looks thin after inflation. Equity indices remain near records because dominant firms keep generating cash and because passive flows chase what has worked. None of these flows are irrational on their own. Together they tell a story of a system searching for safety and return in all directions at once. Watch how the next few months could sharpen the picture. If the December policy meeting delivers another rate cut without a clear improvement in inflation data, questions about currency and bond stability may grow louder. If the delayed inflation report on December 18th surprises to the upside, markets may have to reprice the idea that gentle easing is risk-free. And if the February refunding plan shows an even heavier supply of long-term debt, it will test how much more balance sheet major investors are willing to commit at current yields. The result? If those 3 dates pass quietly, the system can grind on under growing strain, with more of the adjustment happening in gold, Bitcoin, and relative performance, rather than visible crashes. If instead funding costs jump, auction demand weakens, or trade tensions flare back toward triple-digit tariffs at the same time, the break may no longer be invisible. It will look like rising volatility in the safest assets, tightening credit to the real economy, and a slow erosion of faith in the promise that central banks can always step in. Checkpoint 5. Think of a family dinner where everyone keeps talking about the weather while a serious argument simmers just below the surface. The conversation stays polite until one more small comment tips it over. Global markets today feel a lot like that table. Look at the closing frame. The phrase "the global financial system is breaking" does not mean everything collapses overnight. It means the old assumptions are failing in slow motion, that trade stays open, that public debt can always grow faster than income, that any shock can be smoothed with a few interest rate moves. The real story is in the divergences between stocks and gold, between trade partners, between non-bank and bank balance sheets, between what officials say and what money quietly does. Watch for the 3 warning signs together: policy hitting a wall, trade moving from threats to hard barriers, and funding markets seizing up in places that used to be safe. That is the line between another temporary scare and a genuine fracture that takes years to mend.